Okay, perfect. Within equity we see reported in financial statements, we'll typically have a few lines that are different than paid-in capital. The first such account we'll consider is quite an important one: retained earnings. These are the firm's profit that have not been redistributed to shareholders as dividends. This account accumulates throughout the years. Of course, positive results increase retained earnings, while losses reduce it. Companies usually keep a significant portion of their earnings for the purposes of reinvestment, so this will usually be a substantial account within large and mature firms. On the other hand, startups are known for accumulating significant losses in their first years of operation, right? These losses will be shown within retained equity too. In most cases, companies can carry such losses into the future and receive a tax exemption for them. If accumulated losses surpass the rest of equity accounts, we can say the company is in technical default and it needs to be refinanced by shareholders or go bankrupt. Excellent. Besides retained earnings, we can also have treasury stock, which is stock that has been repurchased by the company. This is the firm's own stock repurchased from investors and not yet retired. This account is shown in negative because it reduces stockholders' equity. Remember earlier, we said that outstanding shares are equal to the number of shares issued minus the number of shares reacquired. Well, it becomes clear that shareholders' equity is a measure relating to the number of shares outstanding. And then we have a few additional equity accounts. Non-controlling interest represents minority shareholders' pro-rate ownership of a firm's equity. Let's imagine our company A owns a subsidiary called Company X. We own 80% of X, to be precise. When Company A has to prepare a consolidated financial statement, including Company X's assets and liabilities, it will also have to show in its balance sheet that it owns only 80% of Company X. The way things work out in practice is that Company A will show the entire amount of Company X's assets and liabilities, and then will also report in its equity that external owners have a 20% stake in Company X. This is how Company A's consolidated balance sheet balances. Okay, great. The last equity line we haven't discussed is other comprehensive income. It contains revenues, costs, and other gains and losses that are excluded from net income according to US GAAP or IFRS. Examples of items that will go here are reversal gains deriving from the reevaluation of brands or other assets. We can't show them as this year's profit in the income statement, but they still have to go to equity for the balance sheet to balance, right? That's why they're included in other comprehensive income. Imagine Kering, the owner of fashion brands such as Gucci. In 2017, it revalues one of its fashion brands it had impaired earlier. Is this income that has been generated in 2017, or is this other income that cannot be attributed to 2017? It certainly is other income, right? This is why we'll record it in other comprehensive income. These are the items we'll typically see in a company's equity statement. In our next lesson, we'll talk about how companies raise equity. It should be an interesting one. Stay tuned.